Happy Tuesday out there, Team 42. It's your skipper here at Darius to present our macro minute for Tuesday, February 11th, 2025. Hope everyone's having a great week. So, as always, we'll start with the executive summary from today's leadoff morning note. As always, if you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio, you need to be a client of 42 Macro. So, today's key macro question is: should investors take some chips off the table because of tariffs? Our answers are no. We do not believe investors should ever adjust their positions because of fundamental research views. That is not because fundamental research views are not valuable, they are. Rather, it is because fundamental research views are almost always less effective at timing inflections in momentum than quantitative risk management signals. We built our KISS and Dr. Mo signals for investors who need help systematically and dispassionately listening to and responding to the market. The results of investors who follow our KISS and Dr. Mo signals are spectacular and significantly better than most investors who do not. Regarding the tariffs, the EU has already promised retaliatory measures in response to the planned reciprocal tariffs. Depreciating the euro is the best strategy to offset the tariffs with minimal disruption and reduce the risk of a trade war. We were among the first on global Wall Street to call for euro US dollar parity last year, and we reiterate that view today. Additionally, Catherine Mann of the Bank of England's Monetary Policy Committee just confirmed that she voted for a 50 basis point rate cut at the most recent Bank of England meeting. Recall that she was formerly the most hawkish member of the MPC, dissenting from the prior two rate reductions of the current policy normalization cycle. All told, a much stronger US dollar seems inevitable amid American exceptionalism and fresh tariffs. Precisely when the US dollar becomes strong enough to cause significant problems for global liquidity and asset markets is for KISS and Dr. Mo to decide, not me. We are humble enough to know that we are not smart enough to figure that out using fundamental research alone. Are you? Transitioning to our 42 macro dashboard. As always, a wrap up with the question from our community. This one's on a couple topics. Says, morning, everyone. DD, thanks as always for the A+ weekend content. You're welcome. Thank you. Appreciate you for parting with us. A couple scenarios that are top of mind. I enjoy hearing your thoughts around these general topics. Number one, monetization of U.S. debt, specifically comparing the U.S. Possibilities to the Japan experience. And then number two, a big if, but if Bessent and President Trump are aligned that the ultimate goal for now is a reduction in the U.S. 10-year Treasury, but President Trump wants to see the stock market not crash, how would one attempt to thread that needle? So number one, monetization of U.S. debt on record many years ago, continue to be on record that the U.S. is not Japan. We are a twin deficit nation that foreigners own, I want to say about 15 to 20% of our treasury bonds, marketable treasury market. And more importantly, we are a current account deficit nation, which means every year we constantly need to attract capital to plug our net savings shortfall as an economy. So when you start monetization of U.S. debt, particularly the type of monetization that we saw in Japan, which was, in my opinion, very deliberate and a real kind of, it wasn't really hidden very well in terms of their true intentions, which was to reduce the overall stock of Japanese government bonds on the marketplace. I don't think we can get away with that here in the U.S. For one, we would probably see a significant decline in the U.S. dollar. Recall that Japan was in a balance sheet recession when they were doing all of this. And so balance sheet recession plus having most of the government bond market be owned by foreign investors, particularly foreign banks, which are regulated by the Bank of Japan. In our opinion, we just don't have those same types of dynamics. I want to say U.S. commercial banks own about 15% of a U.S. marketable treasury market currently. So they're roughly just as big as foreign investors, but the reality is we need foreign capital in a way that Japan, which is a current account surplus nation, does not. So that, in my opinion, is the biggest challenge there, because ultimately it would wind up with much lower U.S. If we went down the route of explicit monetization, it would wind up with a much lower U.S. dollar, much higher levels of inflation, and ultimately probably be counterproductive from the perspective of having much higher interest rates across the curve. Number two, big essence. So this the question sort of asks, is there a sort of kind of a push-pull, if you will, from the perspective of the president and Treasury Secretary Scott Bessent wanting lower 10-year yields, but the president, and I would argue Scott Bessent, not wanting a stock market crash. In my opinion, I don't think those things are mutually exclusive. I think U.S. 10-year yields down from here, especially in the context of our inflation being too hot, is probably a better path forward for the stock market, at least from this particular starting point, given that valuations concerns are pretty prevalent. If you look at our positioning model, the indicators within the positioning model that are more sticky and stable over time, and thus more correlated with the longer term kind of performance of asset markets. A lot of those longer term sticky stable indicators are indicating that we are very much in a very full point in the positioning cycle. And so it yields much higher from here will probably cause significant problems. Yields lower from here will probably take some pressure off the system, assuming yields aren't declining because there's a high developing probability of a recession, which our models continue to suggest that there's a very low probability of a developing recession in the U.S. economy. So again, I don't really think there's really much needle threading here in this particular juncture. So we'll wrap it up there. Darius Dell presenting our macro minute for Tuesday, February 11th, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.